Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market rotation, software, semiconductors, and the AI tug-of-war. This video presents a direct informational narration of the source document. All right, let's get right into it. Here's our roadmap for today. We're going to start with a quick update on labor market data, then dive into the massive capital tug-of-war between software and semiconductors. After that, we'll look at the crazy momentum in cybersecurity, the booming custom chip space, structural shifts in equity supply and liquidity, and finally, what all this market divergence means for systemic fragility. Let's kick things off with Section 1, Labor Market Data Update, where we'll look at the latest employment numbers from April. The April JOLTS report came in and wow, it showed a massive surge. We're talking a jump from 6.866 million to 7.618 million job openings. That completely blew past the expected 6.82 million and actually hit a new high for the past 2 years. But when you look under the hood at the breakdown behind that total, things get interesting. The job vacancy rate rose to 4.6%, and the quit rate actually dropped a bit, going from 2.0% to 1.9%. What really stands out is that this growth was isolated primarily to the professional and business services sector, while the rest of the market remained pretty flat. So, what does this tell us? The source indicates this points to a stable labor market, rather than a broad, universal economic acceleration. We'll definitely need to keep a close eye on future data. Moving on to Section 2, Software versus Semiconductors. It's an absolute capital tug-of-war right now. Looking specifically at the software sector through the IGV ETF, the source highlights a really striking contrast. Get this, total call option volume for IGV surged to a record 200,000 contracts on Friday, an all-time high for a single day. And then on Monday, they tacked on another 225,000 contracts. Retail investors also set a record, buying up $46 million in a single day, which is 40% higher than the previous record from back in early February. But here's the wild part. Despite this massive retail inflow, capital rapidly rotated right back out into semiconductors. We saw a 5.87% surge in the semiconductor index where 27 out of its 30 components rose. From a technical standpoint detailed in the document, IGV absolutely has to hold the 111 level. If it falls below that, we're looking at a return to a consolidation phase, and the software sector will just quiet down. Now, I wouldn't necessarily enter a bearish trend right away, mostly because there's a strong historical support zone sitting safely between 94.8 and 86.4. Based on wave profitability ratios, if that 111 level does hold, the downside risk stop loss is around $3, with an upside target of $5 to $7. But for any further breakouts above that, the semiconductor sector really needs to cool down so it stops draining all the available market capital. Microsoft is a perfect example of this dynamic. Even though the company released a series of brand new AI models, that fundamental news barely made a dent amid the broader software weakness. Instead, the stock formed what's known as an island reversal top pattern. It gapped up, and then immediately gapped down. The source identifies this as a highly confirmed top formation, which points to weakening upward momentum. Because of this, the revised downside support level sits at 435 for a shrinking volume pullback. All right, let's jump into Section 3, the cybersecurity momentum, focusing on valuations and some serious volatility. Take Palo Alto Networks, or PAN WNW. They beat earnings and even raised their full-year guidance. The stock did drop post-earnings, but it was much smaller than its typical volatility, which shows a good baseline of fundamental strength. However, the source stresses that the valuation remains heavily stretched. Right now, it's trading strictly on aggressive short-term capital inflows. It's a classic case of strong stocks just getting stronger simply because there's no overhead resistance. Technically speaking, there is no immediate support until the 260 level. That leaves a massive, nearly $30 gap of pure volatility sitting right underneath it. Meanwhile, if we look ahead to CrowdStrike's upcoming earnings, the options market is pricing in some extreme volatility. The options settlement is suggesting a 68% probability of an $80 swing, either up or down. To put that in perspective, that's roughly an 11% move on a $770 stock. The upside is completely clear all the way up to $768, with no significant resistance in between, which just highlights the massive volatility everyone is expecting in this incredibly high valuation space. Next up, Section 4, the custom chip boom and the broader semiconductor rally. This whole move had a massive direct catalyst. NVIDIA's CEO Jensen Huang specifically stated that Marvell could be the next trillion-dollar company.
Well, prompted by that news, Marvell's stock absolutely surged 32%, pushing its market cap to $250 billion. Plus, NVIDIA has invested $2 billion directly into Marvell. This links the two companies together, allowing customers to use components from both to develop their custom AI infrastructure.
Comparing Marvell to Broadcom perfectly explains these capital rotation dynamics. Marvell's smaller $250 billion market cap makes it a much easier target for speculative bidding compared to Broadcom's massive $2.28 trillion scale. Broadcom moves way more actual volume as the established leader in custom chips, but its sheer size makes it incredibly hard to move the stock price exponentially. Both companies operate on similar valuation frameworks, but Marvell just requires far less capital to push the price higher. Looking closer at Marvell's fundamentals, their primary business revolves around custom AI chips, high-speed networking chips that connect servers and GPUs, and optical interconnects for AI clusters. According to the source's assessment, reaching a fundamental $1 trillion valuation would take a minimum of 5 years. Before this massive surge, 44 analysts rated the stock a buy with 0 sells, setting a 12-month target of $230. However, the stock surged well past $313 in after-hours trading. This confirms it is currently significantly overvalued based on traditional metrics and is being driven heavily by pure momentum.
Zooming out, we hit Section 5, Equity, Supply, and Liquidity. We really need to talk about structural market changes.
The source notes a really interesting structural shift: Google's recent move to raise capital by issuing equity. This is huge because it effectively increases the overall net equity supply in the stock market for the first time since the pandemic. Usually, companies shrink equity supply through stock buybacks, which concentrates the value, but issuing new stock dilutes the per-share value, forcing the broader market to absorb that increased supply of shares.
To put this in historical context, periods of net positive equity supply over the past 2 decades have only occurred during 3 distinct times of severe market turbulence: the post-dot-com bubble volatility in the mid-2000s, the Great Financial Crisis in 2008, and the global pandemic shock in 2020. This suggests that if top tech giants continue their massive AI capital expenditures without seeing immediate monetization returns, they are going to increasingly need to issue stock or debt, which will tap into and drain overall market liquidity.
Adding fuel to this liquidity shift is the highly anticipated SpaceX IPO, noted as potentially arriving around June 11th or 12th. The source posits this IPO could act as a massive market event, potentially draining significant speculative capital directly out of the current tech momentum stocks. Basically, investors might secure profits from highly inflated tech assets just to participate in this new offering. This creates a really critical timeline we need to watch for potential market shifts.
Finally, Section 6, Market Divergence and Systemic Fragility Risks.
We are currently witnessing a historic market divergence. The major indices just keep hitting new all-time highs, and yet for roughly 5 or 6 consecutive trading days, the number of declining stocks has consistently outnumbered advancing ones. Basically, the explosive index growth at the very top is completely masking the underlying weakness in the broader market.
This dynamic is further illustrated by volatility metrics. The correlation between individual stocks and the broader index is experiencing what the source literally calls an epic crash. Investors are willing to pay massive premiums for individual stock volatility, whether they are betting up or down, while broader index risk concerns, measured by the VIX, remain exceptionally low. Market participants are completely ignoring broader index fundamentals to hyper-focus on a handful of specific stocks.
So, the document leaves us with 3 crucial structural takeaways. First, the correlation between individual stocks and indices is completely crashing. Second, the market is entirely dominated by AI stock picking, not overall index fundamentals. And third, this dynamic creates immense systemic fragility. The market's success relies entirely on a few flawless leaders. If these leaders stumble, whether in earnings, liquidity, or financial health, the entire concentrated market is going to face massive disruptions.
As we look ahead, it leaves us with one massive question to consider. How will upcoming liquidity demands, like the impending SpaceX offering, test the stability of this highly concentrated and dangerously fragile market ecosystem?